Good evening and welcome to this webinar on self-sabotaging trading. My name's Charlie Burton. For those of you who don't know me, I am a professional money manager here in the UK. I'm regulated to manage money here. I've been trading for 27 years now, and I've won trading competitions. I've been featured in TV documentaries over here and the usual stuff, interviewed in the financial press, etc., etc. So, but tonight I'm here to deliver a webinar for you on this interesting topic on self-sabotage. So let's get into this. First of all, though, we have to go through the risk disclaimer, which is the material provided is for the purposes of information purposes only and should not be considered as investment advice. The views, information, or opinions expressed in the text belong solely to the author and not to the organization, committee, or other group or individual or company. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 72% of retail trader accounts lose money when trading CFDs. Right, let's get into the overview first of all. So what we're going to actually be covering off. So the obvious ways that people self-sabotage. In fact, why don't I put it out to you? First and foremost, someone throw some at me. What are the obvious ways that people self-sabotage? We're going to be talking tonight about the less obvious ways, but let's get this started with some of the obvious ways that people self-sabotage. Overtrading, I'm seeing, chasing losses, greed, revenge trading. Yes, exactly. Yes, manufacturing trades, yeah, out of nowhere, forcing a trade. Yes, exactly. Yeah. Okay, we've got that. Yeah, self-sabotage with no stop losses, of course. Yeah, of course, yeah. Pride, FOMO, wow, they're all there. So that's the obvious stuff. What we want to do is delve into the subtler arts of self-sabotage here tonight and look at the less obvious ways that can affect really up to 90% of traders, and that they unwittingly fall into. So what we're talking about here are the things that tonight there's two ways I'm going to pick up on. Two ways that up to 90% of traders unwittingly fall into. So, and we're going to look at how to test if you're part of that 90%, what adjustments you can make, and what the stats tell you too. So there's a fair bit that we're going to go through. I'm going to show you some visuals on here as well of some tests as well. However, first, I need to go through this with you like I did last month as well. And this is this little microsite that I have with Tickmill. So the website address is tickmill.link/Charlie Burton. We'll come back to that, but I'll show you what it actually is, because that's where, if people haven't seen previous webinars, that you will be able to see them. This is this microsite. I've just given the website there. There's a load of information on here. You can even, if you open a Tickmill account, you can get access actually into my trading community. I have a live trading room, which I'm in with my community 5 days a week. So you can look at all of that. If you become if you're not already an account holder with Tickmill and you would like to get access to my trading community, you can get it for free. Anyway, you can look at all of that. But really, if you scroll down, you'll see down here the educational webinars. They get put onto this microsite every month. So in about a week or two after tonight, then tonight's webinar will get put onto this site as well. So it's well worth your while keeping the link, because you can go into these, and if I scroll across, you can see different webinars going back over this past year or so. So all sorts of interesting content that we've covered off in those. So definitely well worth your while looking at that. Right. And that is tickmeal.link/Charlie Burton. Okay, let's move on. So the less obvious types of sabotage. Now, these really do need considering. But first of all, I'm going to start you off with a trader story. Now, this trader story is really recent. I was literally talking to this trader just the other day, and he'd been in a trade and price had been coming up. Can you see my pen as I'm putting this onto the screen? I just want to make sure that you can see the... Yes, you can. Right, good. So price had come up, pulled back, and he'd been in this trade from back down here somewhere, okay? And so he'd been in a really nice profit, had come up into the prior high, and then rolled over, okay? So he said, I'm never going to do that again. I'm never going to hold on again. Every time that this happens, when I'm in a trade from down here, I'm not going to, and if it comes up and does this again, basically a double top in price, I'm just going to bank it. Okay. And I said, well, that's fine to have as a plan. But the problem with this is that he's basing this decision on one event. So maybe it happened to him on another event as well, but he's basing the decision on one event. So this is so common in trading that something will happen to a trader and then they will then make adjustments to their trading. Well, yeah, I'll talk about the double top, Richard. They'll make adjustments to their trading, based on the experience of one event, because at the point that price was up there, you don't know that it's going to be a double top, of course. At that point, price could have carried on going higher. So it's all very well saying, well, when price comes up to here, I'm going to bank it. And that's fine. If you want, if he wants to adjust his plan so that every time price comes up, does a pullback, and then comes back up to the prior high, that he banks. Well, yeah, that's a new trading plan. What I'm saying is that this is a classic example of someone reacting to something that's happened, when actually, how much of the time does price do pullbacks and then go on to make new highs? So it's okay to bank his profit and say, do you know what, I've had enough. And if that's his plan, that's fine. But what he's got to be careful of is he is the same trader that will then kick himself if he takes that next trade and it carries on going higher. Then he'll be like, oh God, why didn't I hold on to that trade? So what happens is a lot of traders will react to the experience that they've had, and based on what the price has done on that event, or maybe on just a couple of events. And then they start to think, well, I've got to do something. I have to change something. And my point is, he doesn't have to. And if he wants to and say, right, that's it, I'm going to always come out when there's a potential double top in price, there's nothing wrong with that. Change your plan. But at the same time, don't then moan and then start changing your plan again when you get into some trades that become those monster trades and just keep on going. So you can't have your cake and eat it. So yeah, I thought it was an interesting story because it leads into this whole sabotage, because potentially he could be sabotaging himself. And I'll explain as we go forwards here. Now, I appreciate people are writing comments, but I can't keep reading the comments whilst I'm in mid-flow now. So he could close half and do that. Absolutely. That those sort of things are options. Okay. So is one or two instances where a trade has reversed enough to justify changing the strategy? This is the point. Is that enough to justify changing the strategy? Now, logically, we know it's not. We know it's not. But people constantly change their strategy on very little data. That's the problem. So what we're talking about here is essentially strategy hopping. So strategy hopping is a less obvious type of sabotage. We've talked about the obvious stuff, revenge trading, all the things that you wrote down earlier on, FOMO, fear, over trading, all of those things. This is a more subtle one. And this is one that I think is very, very common out there, where people have an experience and then think, oh, I don't want to trade with this strategy now. I'm going to ditch that. I'm going to move on to another one. I'm sure many of you who are here tonight could hold your hand up and say, yeah, I've done that. Because most of us have done that at some point in our past. So, exactly, Susan. Yeah. So now there's nothing wrong with changing a strategy. So like that chap, there's nothing wrong with saying, do you know what? I'm going to change my rules on this. But like I said about that example earlier on, but don't moan when something else happens, like in that example, and his next trade becomes it would have carried on going higher and higher and higher, and then thinking, oh no, I want to change again. So you've got to properly embrace it. So let's move on from this. So there's nothing wrong with changing a strategy, but has it fallen outside the historical performance norms? So this is where you need to go back and test your strategy, your approach, because a lot of the time it may not have done. So if you, for example, if let's say your strategy goes into a drawdown period. So let's say for whatever reason, it doesn't matter what the numbers are. So let's say you go into, you're into a 10% drawdown. Okay. So your equity curve is pulling back, and it's pulled back from its last peak by 10%. And so in this example, this would be a typical sort of example whereby someone would say, oh, I don't like this strategy anymore. And they ditch this strategy and start looking for something else. So the point is, has it fallen outside of historical performance norms? So if you go back to, if you've got the back testing data, and if you haven't got that, you should have at least journal your trades. And if you don't at the moment, start journaling your trades. So you build up a history of trades. Because you might say, well, actually, your data may say, actually, with this given approach, a 10% drawdown historically is perfectly within the realms of its natural ebb and flow of equity. So, in fact, yeah, 10% is perfectly normal. So, and if you're looking to jump around, well, yeah, you're now getting to sabotage, because just at the point when you're jumping out saying, I don't like this, and you're moving on to another strategy, this strategy may be that it starts to hook up again. And if you'd have just stayed with it, you'd have been back at new equity highs. So like I've said, this is the stuff that people do all of the time. This is the less obvious stuff. But strategy hopping is very, very common. And it's something that is very easy to do, but you just need to go back over your historical, if you log your trades, go back over all of that and see, okay, am I making this decision because I'm looking at my P&L? Because is the strategy performing still within the realms of its historical drawdowns? For example, in that example, it may well be that that particular strategy has a historical drawdown, max drawdown of, let's say, 20%. So you're only well within that historical realm boundary there, and yet you're looking to ditch it. So you've got to be careful there. So lean on your data, go back on that if you're using a mechanical-based approach. If you're not, then start logging your trades. And because everybody should log their trades so that you can go back and look at your own data. So has it fallen outside of the historical norms? If not, are you doing what 90% of traders do, which is jump around? Okay, so review your journal. Did you miss any trades, any errors? Because again, when people start looking at things like, in this example, a drawdown, and they want to jump around, that chap that I was talking about earlier on wanted to adjust his strategy purely based on he didn't make as much profit as he could have done. And then he wanted to make that change. Well, again, that's fine, but you need to review all of that, do some testing on it, and test your own data to see, are you more profitable by actually doing that, or actually are you sabotaging yourself just to make yourself feel good? And we're going to talk about that in a bit. So review your journal. Did you miss trades? Are there any errors? Because a lot of people will judge themselves based on their P&L. But actually, there might be trades that you've missed, trades you've hesitated on, errors you've made, you've jumped into a trade. All of that will be in your trade log if you log your trades. And so that is what determines your performance, not the actual P&L. If you review constantly what you're doing, and then you can say, well, actually, yeah, your P&L might be whatever it might be, but it would actually be so much better if I hadn't have missed those trades or any of those errors that I've taken. So reviewing your journal is really important here. That may show, like I've already said, that there's actually nothing wrong using that 10% drawdown as an example, like that chap that I've already talked about who wanted the double, with the benefit of hindsight, when price went up, pulled back, came back up into that high, and he opted not to bank, and he wanted to hold on, and it rolled over. So he's now using the benefit of hindsight based on this, the fact that it pulled back over, that he could have made more money by banking it up here. But as I've said, well, how many instances would there be where price actually just keeps going? He needs to look at that. And then, only then can he make the decision as to whether he wants to change his exit approach. So all of these are potentially self-sabotaging, because he may, going back to this again, one more time, using that example, he may say, no, that's it. Every time it comes up, does a pullback, if it does a pullback and then comes back into that high, I'm going to bank. Well, that's fine. But again, what's the data on that? Is there, in fact, by banking here, yes, that's fine on this trade, but how much of a sacrifice are you having by missing out on those ones that do carry on going higher? So he'll only know if he tests this. So it's the subtle art of self-sabotage, because he may actually find that he's making a lot less money by trading that way rather than the original approach. He was just reacting. So anyway, let's move on. Oh, let's turn the pen off first of all then. Okay, so if you want to change the approach like that chap to suit your personality, that's absolutely fine. Because that chap may say, yeah, I don't want to hang on to that trade. My personality is such that I just want to bank it. Providing the data supports it and it's still profitable, well, yeah, that's fine. But definitely needs to look at, well, how much of a sacrifice is he potentially making by doing that? But anyway, so that's fine. But just ensure, don't become a serial hopper and constantly be tweaking your strategy just based on your most recent performance or the most recent experiences. Okay, so what we're going to do now is we're going to move on to another kind of subtle self-sabotage. I'm just going to show you some backtesting data. Note that this is purely backtesting. I've just used some software to create a couple of simple backtests here. Okay, so let's have a look at this. So this is just showing a backtest of a given strategy over a 10-year period. Okay, so its total return here. This is purely backtesting, like I've said. So the total return over the backtesting period was 229%, giving an annualized return in that of 10.7%. The maximum drawdown that it had over that period was 26%, And the win rate over here is a whopping 27%. Now, some of you won't like that, I know. So remember these numbers: 229%, 10.73% annualized return, drawdown of 26%, and a win rate of 27%. Okay, with this given strategy. Now, this strategy at this point takes a trade. So it has an entry here, and it has a stop loss, a given stop loss, and it has a given target up here, take profit. Okay, so it has a static take profit, entry and stop loss. Fairly straightforward. Okay, and you can see the average win is 5%, the average loss is 1%. So it's around about 1 to 5 risk to reward. Right, now let's go on to the next slide here. Now this one's got some slightly different figures in it. Note, first of all, the win rate has jumped up to 55%. Now some of you will be thinking, oh, well, yeah, that's better. Don't like this 27% win rate stuff. The drawdown is actually slightly higher than the previous one. And look at the annualized return. It's now dropped to 6% or so, 6.25%, and the total return has more than halved. Okay, so what's the difference? The strategy is exactly the same. The only difference is the stop loss gets moved up to break even. Yes, ladies and gentlemen, it's another massively common theme with traders wanting to move their stop to break even. Now, there's nothing wrong with moving your stop to break even, but where a lot of traders go wrong is, have they tested that? And a lot of the time they're doing it too soon. So in this example, the stop was getting moved to break even once, once price has moved a given amount. But the point is that there was a massive sacrifice. I think it was when once it was into profit by 1R, then, or 1% in this regard, then the stop was moved to break even. But it was a massive sacrifice in returns. So the overall return over the 10-year period halved. The annualized return obviously was lower. Yes, the win rate was higher. And I've pointed this out because there'd be a lot of people who would still say, yeah, I'll take this one. I'll make that sacrifice just to be right more often. The power, the psychological power of people wanting to be right more often. Of course, we want to be right more often. We would rather have higher win rate strategies. But the point is, at what sacrifice? At what sacrifice are people making purely to essentially have a higher win rate by moving their stops up? It's something which, don't get me wrong, certain strategies will work well, will be improved by moving stops to break even at a given point. The point of this, what I'm showing here though, is have you tested it? Because that example shows how moving a stop to break even could damage overall performance. If you move your stop, do you know for a fact that that's the best approach? Again, this comes back down to, are you sabotaging your total performance just because you want to make yourself feel good? Because that's what it comes down to a lot of the time. People move their stops up because then they can say, oh, it's a risk-free trade. Well, is it a risk-free trade if it's affecting your total performance? So again, we're talking about going back and testing. We've tested thousands of systems. Myself and my programmer, we've tested thousands of systems, and guess what? Yeah, you know it. 88% of the tests that we've done on those systems perform better by leaving the initial stop alone. Just leaving it alone. because you don't always have to move stops to break even at all. In fact, in that example, you're just better off. You're going to make twice as much money over that 10-year period by leaving the stop alone rather than just moving it up to break even just to make yourself feel good. Yes, you'd still make money, but it's that sabotaging of profit that goes on. So I would encourage people, if you, like most people, I move my stops up on my trades, but there's a point at which I will move my stops up. So I would encourage people to, if you're using a given strategy, just to question your own strategy and say, okay, I'm moving this stop up at this given point, but actually I haven't back tested that. Am I better off leaving it alone or not moving it until the trade has moved further into profit first of all? So I'd encourage you to have a look at that. This is what I'm saying here today. It's about the less obvious types of self-sabotage. That's what we're talking about here tonight. We're not talking about the obvious ones because we all know that. This is the stuff that you can take away and say, right, I've got some work to do here. Am I strategy hopping? Am I a strategy hopper? Right. Am I needlessly hopping from one strategy to another without even realizing when I'm making changes, making adjustments, the consequences of that? Test it, like that chap in that story. It's fine to bank at a double top, but test it. Is it more profitable for you to do that every time you get in a trade setup like that? And like this data that I've just presented here, do you know that you're more profitable moving your stop to break even, or are you doing it because of an emotional reason, i.e. wanting to make yourself feel better? Okay. So what do your stats say? The majority of retail traders are self-sabotaging in that subtle way, and they don't, as I say, they don't even realize it. So, key questions to ask yourself. Am I strategy hopping for the right reason, or is it simply to make me feel better? Am I moving stops for the right reason, or is it simply to make me feel better? Again, are you strategy hopping just to say, oh, I'm going to discard this one because for whatever reason, it's not making me enough money, or I'm going to massively adjust it? Well, hold on a second. Are you just massively adjusting it like that chap just on the back of a couple of instances? Have you actually got enough data to justify making that change? Go back and test that. Likewise with moving the stops. Am I just doing it to make myself feel better, or actually is it proven that moving those stops is better for me? Record your trades and review both those that you took plus those that you missed. And this is another thing that people, as part of self-sabotage, that they don't log the trades that they missed. And really this is about people that are following a more systematic approach, following a mechanical, rules-based approach. They log all the trades they take. They don't log the ones they missed. So why is that important? Because it's a collection. You're collecting data. Just because those ones you missed for whatever reason doesn't mean to say they shouldn't be logged, because at least it's giving you that information to tell you whether overall that strategy is even more profitable. Just because you may have missed some, maybe you hesitated because you'd had a couple of losses beforehand and fear gripped you a little bit, all of those things. So it's all self-sabotage really. And even when logging a trade, we can be self-sabotaging if we don't log the ones that we missed. So really useful to do that as well. If you trade mechanically, as I've just said, what does the historical backtesting tell you? Simply looking at these two parts of your trading can result in really significant performance improvements. So subtle, yes, but could dramatically change your trading without you having to go and find a new strategy. And with regards to moving stops, you may well find your strategy you're sitting on is actually a little gold mine if you just left the stops alone for a bit longer. So really worthwhile having a look at that. And finally, now, okay. I thought that, so we've pretty much covered that. I said it would be a shorter webinar tonight as far as the actual presentation element. I've just got a couple of slides more to go through here. I found this funny, and I've got a couple of sentiment slides here. This from Forbes, actually a few months ago. An imminent stock market correction warning suddenly flashed red just as the S&P and 500, what it was saying was just as the S&P was making new highs, this stock market correction warning flashed red. Well, right now, this was a few months ago. Most of you know what the stock markets have done this year, and the S&P and the Nasdaq particularly, and the Dow. They kept on making new highs. And so when you see these sorts of articles, you have to be very, very careful from a sentiment perspective. That when you see articles like this talking about stock market corrections, look for the reasons why the stock market might go higher. And just like that, let's now look at something else here. The Economist, just last week, Economist magazine, I'm sure some of you have seen this, front page, the envy of the world, America's economy special report with the dollar on fire there. So again, we can't just immediately use this information and say, well, in that case, the US economy is going to probably underperform. We can't, and therefore short the dollar. But it certainly should be something that we keep an eye on when we see this sort of stuff. When we see these types of front magazine covers, and I've done, if you go onto the micro site, I did a whole webinar just recently, one of the a few months ago, it's on the site, where I covered off set market sentiment, but certainly they are a warning sign. So when we see this sort of stuff, so the only thing is, they're not always the greatest of timing tools. You see something like this, yeah, it may be that going into 2025, the US economy maybe stutters a little bit. I don't know, but it's just so often that when we do see these sort of articles out there, that the opposite happens. So, for example, what's been going on, what's been attracting a lot of attention from a sentiment perspective in the last week or so, and I'm actually just going to switch to the charts now. There you go, sentiment extremes. There you go. There's a webinar there on the microsite. But if I bring up gold here, gold has been attracting a lot of attention lately. So lots of articles talking about gold going to the moon, gold going to XYZ prices, and all the reasons why gold's doing so well and is going to continue to do well. The problem that we tend to have when it comes to sentiment is journalists, financial journalists, aren't going to start writing about something until it's already had a great run. So gold is starting to get picked up by the masses now, because the masses are starting to hear, oh, gold's having a really good run. I need to get into gold. Paul Tudor Jones, one of the world's most famous hedge fund managers, was interviewed on CNBC just 2 days ago, talking about how he owns what? Gold, Bitcoin, and that he sees them going a lot higher. Now, people would say, well, Charlie, surely Paul Tudor Jones, one of the world's most famous hedge fund managers in the original Market Wizards books, if he's saying that, oh, I've got to get in. Well, there's an element of context there. You also have to appreciate that hedge fund managers may talk up their own book at times. So is it in his vested interest to talk up gold? Yeah, it may well be. So gold is attracting generally a lot of chatter around it at the moment. So from a sentiment perspective, like those articles I've just shown, I'm not saying that gold has to come down straight away just because everyone's talking about it, but what we are starting to see is the sentiment towards gold is starting to get frothy. So I just think it's a warning sign. It's not a timing signal. These sorts of things are not always the best of timing signals, but they are certainly a warning sign that a given market or economy may be getting a bit frothy, and so start to look at technical levels that markets may be going into, and certainly be aware when everybody's long, who's left to buy. So as gold is making more and more news headlines, at some point it's probably going to have to take a breather, is what I'm trying to say. So I am personally invested in gold and silver. I have a vested interest myself in gold, silver going higher, but I also appreciate that they're going to have to pull back at points as well. So I'm very attuned to the rhetoric that's going around at the moment. So it doesn't mean to say the gold has to top right now. I'm not saying that, but I'm saying it's starting to get frothy from a sentiment perspective. So it may not be that, gold may carry on making new highs for the next couple of months, but certainly if that was the case, then that rhetoric, that frothiness is only going to get, that euphoria is only going to get stronger. So I will then certainly start to get a bit cautious as it gets closer to what? Big round numbers. Where are we at the moment? Oh yeah, 2,700. We're not that far away from 3,000 now, are we? So just a point of note there. So again, back on my micro site, I talk all about sentiment there anyway. Right, let's go back over to, the last slides here. I don't know if there's anything more here. Yeah, the final slide here, then we'll take questions. Again, from Bill Lipschultz. Now, Bill Lipschultz was, again, another Market Wizards. I think he was in the second Market Wizards book. And he said, if a trader is motivated by the money, then it is the wrong reason. A truly successful trader has to be involved and into the trading itself. The money is the side issue. The principal motivation is not the trappings of success. It's usually the byproduct. Simply stated, the game is the thing. So if you can always keep that mantra for yourself, yes, everybody who gets into trading is in it to make money. But you've got to enjoy it. You've got to be passionate about the art of trading. Because if you're not passionate about the art of trading, when the markets aren't doing what you want them to do, and maybe they become frustrating, what are you more likely going to do? Become frustrated, bored, or just, throw in the towel? You have to really engross yourself. And that's what Bill's saying, and be passionate about trading in its entirety. And there we've got our final slide there, which is the risk disclaimer again. Okay, right. Nice and succinct here tonight. Let's have a look at some of any questions or comments that have come through here. So someone asked Jeffrey if you're still there, the recorded session. Yes, the recorded session, if I go all the way back through the slides to the beginning tonight. Oh, there we go. If you've come in late, if you take this link, tickmill.link/Charlie Burton, that is that microsite where these webinars get put onto. So I suspect tonight's webinar will get put on over the next week or two. It sometimes takes the technical people at Tickmill. They have to chop up the beginning of the webinar and then put it on. So it usually takes a week or two. So all my past webinars, you will see, just scroll down on that page and you can access those. Hopefully that's answered Jeffrey's question there. Yusuf, what gets you is getting stopped by a pip or so, then it goes your way. Okay, so Yusuf, if you're still there, that's a good question, or good comment, should I say. So again, have a look. It may well be that your stops are too tight. If it's happening a lot of the time, then that tells us that your stops look at your stop placement, and you might have to just have a slightly wider stop than you're currently doing. Because if it's happening a lot, then that suggests that that's just a stop placement issue. That's a dollar rocket in it. Yes. Rocketing. Yes. Yes, Joe. Uh, where or how can I backtest a strategy? Well, Dino, you can manually do it. So you can manually scroll back the charts. There are pieces of software such as Forex Tester that you can, if you want to use some form of programming, so you can use that as well. So there's loads of way to do it. You can just Google it. But there's no substitute for just bringing the chart up and manually doing it as well. I still like old school back testing and logging all of the historical trades. Where do you find the sentiment headlines? How can we track these? Mahesh, that's my job. So I'm always scouring around Twitter, Google searches, you name it, Mahesh. So yeah, always scouring around in my trading community. Sometimes it's some of my members will bring up I've got one from today, actually. One of my members just saw this today. So look, I'll bring this up. Let's bring this across. So this was, again, quite interesting from a Gavekil research. So quite popular in America. But this is almost like a sentiment indicator here, because they've said, look at the lineup here. US bond yields will never return to their post-2008 trading range. Well, the post-2008 trading range is down here, basically below 3.2%. Okay? So what they're saying is, yeah, bond yields are never going to go back below 3.2%. Might well be there's a sentiment indicator in there, and maybe they do. So, yeah, within my trading community, people will say, "Oh, have you seen this? Or have you seen that?" And so, yeah. But yeah, I'm on the lookout for those things as well, Mahesh. So yeah. What software do I use for backtesting? Well, David, I will always backtest something manually first myself, and then I've got my own software that my programmer put together for me, that myself and my trading community use. So that's my own stuff. So if you wanted to become part of my community, then by all means you would then be able to get access to that. But otherwise, yeah, just manually do it. Just bring up the charts, scroll back. If I'm looking at any brand new strategy, I always manually backtest it first of all, before I actually hand it over to be auto-tested. Because I want to see it. I want to see the price bars, how the price bars react, how they move. So you can't see that by plugging it into a system, the system just, churning out a load of data and numbers for you. So I do like doing that first. Don't get me wrong, I will then have it auto tested, but I always like manually doing it first. Carlos is saying, as a trend follower, choppy markets must be hard for you. I know you don't strategy hop, but do you have other methods to cope with choppy markets? That's a really good question. No. That comes down to the psychological side of things, Carlos. I don't tend to jump around, as you've said. So if a market goes into a choppy period, I don't make money. That's it. People are like, oh, well, that's a revelation. Yeah. If a market goes into a choppy period, I'm not really going to be making any money. I need a market to, and I accept, and I'm okay with, yeah, of course, markets are going to go into choppy periods. So I'm not going to adjust and try and jump around all of the time, because I know that over the longer term, that's actually not going to, just as you jump around, then a market breaks out. So no, I just stick with what I do and accept there's going to be periods where I'm going to get chopped up. Yeah. Adnan, how do you become a member? Well, you can become a member for free here. That's why I gave you that link earlier on, the tickmill.link/Charlie Burton. So check out that webpage. Yeah. Am I right in thinking that this is from Richard? There's a lot of questions coming through here. Some of you are posting them just to host some panelists, and some of them you're posting so that everyone can see them. It doesn't really matter, but you just change the drop-down box if you want it so that everyone can see your question. Am I right in thinking most people are taught the same placement of stop loss, so stop hunting is a given, so you should place your stop in a less obvious place? Okay. The answer is twofold to this. It's a really good question. Okay, let me bring up a chart. Let's use gold here as a nice example. So what Richard's saying here is the traditional places to place your stop, i.e. you've got in, I don't know, so let's say you've got in over here somewhere. Pop your stop below the low there. Okay, so the traditional places to place your stop are, you're going to get stop hunted. Well, no, not necessarily. Only if a market wants to go that way. There are plenty of examples like this one here, where price even here just did a pullback here, wouldn't have come back and stopped you out. And likewise over here. So if you've got in over here somewhere and you've put your stop below that low, no, you've not been stopped out because it's moving in a certain way where it's not happening. Don't get me wrong, there are going to be times when you will get stopped out on your low here. So I think there's a lot of people out there who trader gurus who prey on people's fears about getting stopped out. So they say, right, you need to have your stop in a different place. And which is fine if it works out on a risk to reward basis, but what they are really doing is they're just preying on people's fears a lot of the time. One of my the members of my community is an ex-institutional bank trader who was managing up to £1 billion of money. And I was chatting with him a year or so ago on a microphone in a joint session. And we were talking about this very subject. And he said, do people really think that us institutions have got the time or inclination to be doing stop hunts for retail traders? We don't care about retail traders. Retail traders aren't big enough in the market to make it worth their while to be doing that sort of thing. They're just getting on with their own trading. So these are some of the myths that you hear from trader gurus, unfortunately, that are out there and out on social media and stuff, because they're just preying on people's fears. So don't get me wrong, they're like Mahesh earlier on. If you're constantly getting stopped out, then it suggests your stop is too close to the market. But there's nothing wrong with having a stop at a traditional place like that, below that low, for example, or below a given low. There's absolutely nothing wrong with that. And if you just get stopped out, it's fine. The point is the strategy, is the approach profitable overall? Doesn't matter if you're getting stopped out 50% of the time, does it? If the overall risk reward is good and you're going to be making money. So yeah. Anyway, hopefully I've given you some food for thought there. Right. Yeah, exactly, Carlos. I hope I answered your question as well. What about sorry, I'm seeing a lot of questions, you see. There's plenty of people in here again tonight, so lots of questions coming through. What about trying to look into putting your entries where you put your stops? Entries where you put your stops. I don't quite understand that. If you put your entries where you put your stops, then you're just going to get stopped. Basically, that would be putting so you go long at a given level and then put your stop at that same level. You're just going to get nicked out all of the time. It'd be way too tight. So I think what people need to do is accept being wrong more often, getting stopped out more often. There's nothing wrong with it. Test the system or a strategy and approach, and you'll soon then see whether that given strategy or approach is profitable with a given stop loss or stop loss placement, whatever. The data will give you the answer, and sometimes the best strategies actually have a win rate of what, 40%, 30%. Paul Tudor Jones, his historical win rate used to be something like 35%, one of the world's best hedge fund managers. Problem is with retail are obsessed with having 80% win rates. So unfortunately. So anyway, right. Is it okay to have more than one trading strategy? Yes, absolutely. Yeah. You need mentorship. Gasson, sorry. How can I get it? I'm not here to be offering that sort of stuff, Gasson. So that's not really why I'm here. I'm here to coach you here tonight on this specific, or give you some ideas tonight on this particular subject. By all means, you can join my community if you wanted to, but look up. That's on the website that I've given there. Okay. Where are we? What are your thoughts on order flow using depth of market and delta footprint for entries on support and resistance zone? Yeah, you can use order flow, depth of market, if you're an intraday trader. So that's more of an intraday trader tool. Not really going to be of any use for swing trading, but it's just a way of trading. So it's not like, it's some sort of holy grail. So again, you just have to accept that whatever your approach is going to be, so using something like order flow, it's no guarantee that you're going to be any more profitable with that than any other approach to the market. So yeah, I'm generally quite pragmatic to trading. I don't really care what style or strategy or approach anyone wants to use. The main point that I always like to make is there aren't holy grails. And so it's very, very rare that one particular approach is going to be stand out above another or whatever. So it's really about the individual and how the individual personalizes an approach to the market. Enzo, self-sabotage has a lot to do, you think, with the subconscious mind? Absolutely. I had a psychologist in my trading room today, and so we were covering that very subject. Have you used or do you recommend strategies, approaches to work on this area? Well, there you go, Enzo. Literally, I had a psychotherapist who deals with anxiety in people generally, but he's dealt with and he's worked with a lot of traders. And so he was talking about things like limiting beliefs and all sorts of other things, and how to choke off some of the subconscious signals that become or come up to the conscious mind. So yeah, and how it will work with things like that. So yeah, yes, absolutely, it comes down to the subconscious. Yeah, so we can reprogram that by creating habits. So, and there's lots of stuff that I do on that with people. What do you do if self-sabotage, but it actually ended in a good profit or at least a profit? Well, Yusuf, if you're talking about an individual instance there, so what I'm talking about is people that are self-sabotaging constantly, it's more like, yeah, you could jump into a trade through FOMO and it works out. Okay. So that's self-sabotage. Yeah. It worked out. But if you carried on jumping into trades, time after time, and over 100 instances of you just jumping into trades emotionally, yeah, more likely you're going to be losing money. So yeah, in an individual instance, it may well have worked out. But the problem with that, coming back to the subconscious, you've just trained your subconscious mind. Oh, that was okay. Oh, we're going to do this again. And this is how people create these bad habits, because if something that you did was, was the wrong thing, but it still made you money, your subconscious is very powerful. And it's going to be saying, well, no, this is great. We're going to do this again. So you have to be very, very careful. You have to use a lot of self-talk. And so how would I go about that? I would say, if I carry on doing this, I may have made money today doing this, but out of 100 instances of me doing this, I will lose. And you need to repeat that sort of message and get it ground in. Because then you can say, oh yeah, phew, I got away with that one. But if I kept on doing that, I'm going to end up losing money. So I can't afford to just jump into trades on a whim. I'm using a FOMO as an example now. Do you see what I mean? Self-language, self-talk is so, so important. Right. So I'll carry on now because there's a lot of questions here, and we're doing the usual here where I'm trying to catch up with the question. How does one get rid of strategy hopping? I don't know, Sean. Again, if you are a culprit of strategy hopping, like I've went through earlier on in the presentation, the data will tell you. But the data will tell you whether you're jumping away from something where there's nothing wrong with it. But if you're still finding you're doing that, then again, self-language, self-talk comes into play. If I give up this strategy right now, only to go into this new strategy, is that going to be to the detriment of my overall profitability? Yeah, I have been here before. Yeah, it probably will be. Again, this self-language, self-talk is so, so important. Yusuf is saying, one guru said stop losses are the main reason why traders fail on a big YouTube channel. Well, I don't need to know whoever the name of that, because we can't share that publicly, but it's people like that who give the industry a bad name, ultimately, in that they're preying on people's desire to be right as much as possible. Don't use stop losses. You're just going to get stopped out. So don't use them. And if any of you have heard any of the interviews with the owners of Tickmill, who are hedge fund managers themselves, they will confirm that a high percentage, because they can't control what their clients do, but a large percentage of their clients don't use stop losses. And guess what happens to them? Yeah. And we get this across any broker out there in the industry will say the same thing. Traders will get away without using stop losses a lot until that one trade that you imagine if you had have said, right, that's it, I'm going to short gold down here. Right, I'm going to short it. And then that one trade, it doesn't ever come back for you. And it just keeps coming back, and you're sweating through this consolidation. Maybe it's going to roll down back for me and I can get out down here, only for it to then carry on up and up and up until you end up blowing up. So, no, I'm never going to recommend that sort of thing. Why an MT5 and TradingView chart commonly timeframes are in odd numbers, such as 2-minute timeframe chart will have less noise than 1-minute time frame. Is following an odd number time frame a good idea? Okay, yeah. So a 5-minute chart. We do impose maybe our own psychology in that, from a time perspective, into our charting time intervals. So we go 5-minute, 15-minute charts. I don't know. The one thing that I will say to you, Arafat, is please don't trade off of 1-2 minute charts. You shouldn't be doing that anyway. So yeah, go up the time frames a bit. 1-minute time frames, 2-minute time frames. It's a bit dangerous, really. So I'm not going to advocate that anyway. What markets do you trade? Always the same or changing? Mostly the currencies, gold, and the stock market indices. To gold, silver. Those are the markets that I'm analyzing all the time. The major currency pairs: gold, silver, S&P 500, Nasdaq. So yeah, in the main. I'm doing intermarket analysis on other markets. So I'm looking at the bond market a lot of the time. And obviously I look at oil as well. But actually physically trading, it's the major currencies first and foremost. And then I will, through the year, trade the stock market indices as well. So there you go. What if you know about self-sabotaging and the various ways they play out, but once you are on the charts, all that knowledge flies out the window, only to come back after you mess up? Yes, absolutely. How can you change that? 100%. That's so common. I said it in the presentation earlier on. I'll just bring the presentation slides up But I said in the presentation slides earlier on that yeah, logically people will know a lot of the time the things they should and shouldn't be doing. And then when they put money on the line and when they actually start trading, then that all flies out the window, as you quite rightly say there. So you're saying all that stuff, but once you're in the charts, all that knowledge flies out the window. How only to come and mess you up. How can one manage that? Well, I know I'm a bit behind here. There's 26 new messages I haven't read yet, but hopefully I've given you some ideas as far as self-talk is concerned. So another example would be, okay, when to use an arresting mechanism, all right? So you want to jump into the market because the market's moving and it's doing something. You need to then sort of say, look, if I take this trade right now and it rolls over and it stops me out, will I kick myself? Will I be upset with myself? Because if the answer is yes, then you don't take the trade. You need to keep using self-talk all of the time. Yeah, actually, if I take that trade now and it doesn't work, yeah, I should, So I work a lot with traders on the psychological side of trading. So using self-talk is all important, because if you say to yourself, well, if I take this trade right now and it stops me out, yeah, I'll be upset with myself. There's your answer. Don't take the trade, because every trade you take, if it's a losing trade, that doesn't mean it's a bad trade. It's just a losing trade. So there's your answer. Just being stopped out on a trade doesn't mean the trade was a bad trade. It should be a good trade that just got stopped. That's all. What did it follow your plan? Yes. Right. It was a good trade then. It just didn't work out on that instant. If you took 100 trades of that setup, you wouldn't expect 100 of them to work out. That's why we use stop losses. But over the course of that 100, we'll end up being net profitable if we stick with the rules, etc. So self-talk is really important. It helps act as an arresting mechanism. So another one is, I can't afford to take that trade. I can't afford to jump into the market there. Because if I did that every time, jumping in over the next 100 trades, it may work on this instant right now. But all I'm going to do is feed myself, my subconscious, and I'm going to do it over and over and over again. And I'm going to end up losing money. So even if I jump into the trade right now and it makes money, all that's going to happen is I'm creating a bad habit. I can't afford to take that trade. See? Self-talk. I have loads of that stuff. Good stuff. Not quasi. Good. You're going to have to bear with me, folks, because you may have written comments ages ago, and I'm only just catching up on some of them. Yusuf, you're saying, yeah, even when you actually say you want to exit on a certain level, sometimes you freeze and you don't exit. So better leave it to the system to close it. Well, you don't have to auto trade. You're still going to suffer with psychological issues if you haven't got on top of your mindset. You're still going to have mindset issues, even if you were to set up your strategy and have it auto trade for you, because you're still going to be watching the results. And then when the results are going fine, yeah, you're comfortable with it. And when the results are pulling back a bit, you're more likely to, I think I'll switch it off now and all of that. So it always comes back down to mindset. Don't ever think that, an automated sort of program approach is the answer, because it's not. Oh, okay. Arafat, you're asking, yeah, why don't they have that as a default on those time frames? Sorry, yeah. Well, yeah, but you can put those in. You just manually put those time frames in, Arafat. So you can do that in TradingView. I don't know about MT5. I'm sure you can. You can do it on MT4, so I'm sure you can do it on MT5. So there you go. How important is lunch? Oh, I was going to answer how important is lunch there from Sean. Very important, Sean. But lunch liquidity, not really that important to me. Again, you're coming at it from an intraday perspective. The lunchtime period, yes, markets can go a bit quieter at certain times of the day, but other days they won't. And so, I'm not that big on liquidity, as people use that word, because there are times when markets are, during what you would think be a quieter period, and they're not. So I don't think so. Timescales do I trade? I'm a swing trader nowadays, Talma. Although I've won trading competitions, these days I swing trade because of time, and takes up too much time intraday trading for how I used to trade. So no, I just swing trades, which still means that I will swing trade off of. I'll come right down to 4-hour charts, sometimes even an hourly, if I'm looking to get into a swing trade off a given level. So I will still come down to sub daily time frames, but in the main, I'm trying to run my trades for multiple days or multiple weeks, more so multiple weeks. My thoughts on the stock markets for Q4. Now, Adnan, I can't, because in 2 weeks' time, actually, it's not even 2 weeks' time, it's a week next Sunday, we're doing a webinar. So that's Sunday, the 3rd of November. We're doing a webinar on the outlook around and post the election. So I better not go into all that now. So mark it in your diary. We're doing a Tick Mill webinar on Sunday, the 3rd of November. So that's 2 days before the US elections. So we're doing an election special on that. Good stuff. I'm seeing that. You meant stop loss rather than a mental stop. I don't know. I'm lost now, Yusuf. I've just caught up with your bit. Some people say no stop loss in, just a mental stop. Mental stops are for mental people. So the thing is, even God uses stops. Just remember that. So we always use that as a line. Even God uses stops. So the if you use a mental stop, okay, you've got to then have the discipline. If your mental stop is here, whatever that level is, I'll just write on 103. Okay, there's a couple of things to mention here. One, you've got to have the discipline to actually come out, which is actually quite difficult, because then people say, well, I'll just give it a little bit of wiggle room. And then before they know it, price has gone a lot lower than where their mental exit was going to be. Or you go and get some news and it flushes right through that level. So then again, you get a worse stop out, even if you do come out. But then what can happen is then people don't want to come out. They think, oh, well, I'll wait for it to come back up and then I'll come out. Well, what if it doesn't and it carries on coming lower? It is ridiculous. Anyone who advises mental stops, they don't know what they're doing. I'm being pretty serious here. So, and also, do you really think the market is coming down for your one lot trade? Because the market knows your one lot stop loss order is there. So if this is your stop loss, if you did put a physical stop loss in, do you really think the market is coming for your one lot when there's thousands and thousands and thousands and thousands of lots in the market? No, it's not. So, yeah, there you go. There's my answer. Right. Good stuff. What was the date again for the webinar? The 3rd of November. Looks like we've got to the end of the questions, but if you have got any more, by all means, I've caught up by looks of things now on the questions. So if you've got any more, by all means, do write them down. I'm not going to talk about the markets at the moment, specifically in relation to the election, because of that webinar that we're going to be doing on the 3rd anyway. So, but thank you very much for all of your questions again there. And hopefully I've been able to answer and at least give you some food for thought tonight on testing your data, testing whether you're moving your stops up is the right thing, testing whether actually are you jumping strategy just before, when there's absolutely nothing wrong with it. So there you go. Yeah, thank you, Mahesh, and thank you everyone else there. There's still loads of people logged in, but yeah, thank you. I'll keep talking while everyone's coming through. Talma, thank you. Arafat, you're saying this discussion helps you a lot. Good. Yeah, do check out the other webinars on the micro site there. If I bring it back up, because there are. Where's it gone? There. There's a few in there. I don't know if I did. If there's one on psychology in there. Let's have a look. No. Okay. It doesn't look like I've gotten in there. That's one for the near future then, by the looks of things. I've definitely done one before, but maybe it's just not uploaded in there. So we'll do one on trading psychology at some point as well. Joe, thank you. Pritish, thank you. Adnan, Teresa, Yusuf, again. How many sessions your silver membership get? Oh, you've been on my website, haven't you? I think they get 2 a week. We tend to do about, just to give you an idea, 3 or 4 sessions a day. They get 2 a week. There you go. All right. I'm going to leave you to it. Enjoy the rest of your days or your evenings. And thank you for coming along.